Hello and welcome to the last video I'm going to ask you to view this semester. I only have a few slides in here, so it shouldn't take very long to get through them. The topic that's covered in the chapter is what we refer to as responsibility accounting. And then there's also a section that deals with variances and the analysis of those variances. Responsibility accounting is, as the middle bullet indicates, a system that allows individual areas of the organization to be assigned to individual managers so that responsibility can be established, and if there's an issue, we know who to turn to discuss it. In applying responsibility accounting, we refer to so-called responsibility centers. There are 4 of these responsibility centers that are discussed in this slide. 3 of them are the same as what you have in your textbook. A 4th is a little different. I'm going to talk about it. And then also there is another responsibility center that is mentioned in your textbook that in general we don't assign as responsibility centers in accounting, but that's okay. Just pay attention to what's in the textbook. Don't worry too much about the fact that it's not listed on this slide that I'm going to show you. The next slide is going to discuss these so-called responsibility centers, and I would refer you here to the first bullet in terms of what those items are. We can divide an organization in numerous different ways in order to be able to establish these so-called responsibility centers. As I indicate that there are 4 that we typically talk about. The one that's in your textbook that we do not generally consider a responsibility center in accounting are service centers. Service centers are areas that provide services to other areas within the organization. Consider, for example, the data processing center within the organization, which serves various areas, or maybe your maintenance janitorial center, which is involved with maintaining equipment and cleaning areas throughout the facility. Both of these areas would probably be viewed as what we refer to as cost centers. And in probably the laboratories that you are all working in are also viewed as cost centers, in that generally they are not producing any sort of revenue to offset the costs, at least not directly producing any revenue. Consequently, cost centers are areas where we look at them from the perspective of their ability to control the costs that are incurred within that center. And typically we're going to evaluate management on their ability to control those costs within the organization. We also have what are called revenue centers. This may be something that does not really occur that frequently in an organization like a hospital. Revenue center would be an area that is accountable for revenues only, and typically in a for-profit organization that's involved with the sales function may be viewed as a revenue center. We're not that concerned with the cost that they incurred. They're evaluated on their ability to generate revenue for the organization. Profit centers are those places that have both revenue and cost assigned to them. So in that case, we might be talking about the hospital itself, where a patient comes in and is serviced. There are costs that are incurred in servicing the patient. We measure those costs. And of course, then the patient and or their insurance is responsible for paying for that, which becomes the revenue that the organization books. In cases where both revenues and costs are incurred, we can evaluate the division or the center on the basis of their ability to generate a profit. And then finally, we have investment centers. Investment centers tend to be macro types of entities in that the organization as a whole is going to be a profit center. We're certainly going to expect it to generate profits. But at that level, they're also responsible for investments that are made. So in your organization, it might be that the clinic itself, the Cleveland Clinic, is an investment center. And not only is it a question of generating profit, the bottom line, but also investments that are made in equipment and so forth are accounted for by evaluating their ability to make a return on those investments. In those cases, for instance, if the clinic establishes an expectation for return on investment of, let's say, 10%, then they would be evaluated on their ability to generate a return either at or in excess of that amount. I can't emphasize enough this concept of controllability. As managers, you're going to be asked to exercise control and at various levels within the division or segment that you're responsible for. It's important to note that not all costs are under your control. Once the organization has determined that they're going to buy a particular building, that they're going to buy specific equipment that they're going to place in that building, that's not something that you necessarily had any input on in terms of establishing whether or not that item should actually be purchased. Consequently, to the extent that costs are incurred with respect to those items, it's not your responsibility. You cannot be held accountable for differences in the costs for items that you have no control over. On the flip side, you do have some responsibility for those costs you do have some control over. So for instance, if it was your decision to hire a particular individual and that particular individual doesn't do the job as well as somebody else might, then it's going to be your responsibility and you'll be evaluated in part based on the decision that you made to hire that person. Implementing responsibility accounting is made significantly easier by having budgets in place. We've already had a chapter that discussed budgets. As it indicates here, they offer feedback in the form of variances. I mentioned variances briefly in the budgeting chapter when I went over them. This chapter deals with them a little bit more in depth, and we'll talk a little bit more about them tonight. As it says, variances give you the opportunity to see when a problem is coming, perhaps before it becomes big. It also allows you to evaluate performance, not only of the entity, the division that you're responsible for, but also at some level you and your people can be held accountable to what the budget establishes they should be doing. Budget variances can arise at both the revenue level and at the expense level. In establishing what the variance is for a particular item, it's important to rely on what we refer to as flexible budgets. I believe I mentioned previously in the last chapter, a flexible budget is one that is prepared at the level of activity that is actually accomplished. Therefore, you're comparing apples and apples. For instance, you're expected to run 100 tests in a particular month and you end up running 200 tests in the month, then clearly one would expect there's going to be cost differences if you're comparing a budget for 100 tests with a budget for 200 tests. What you really want to do then is reestablish a budget that shows what the cost would be expected at a 200 test level and then make comparisons of the variances that arise from that budget with the actual activities. We can establish variances for every single line item within a particular budget, as long as there's an ability to budget or project what a particular revenue or cost is going to be. Budget variances can arise because either the volume is not what it was expected to be, and we often refer to these as volume variances, but they can also arise because the cost or the revenue item that's being measured is not what it was expected to be. And of course, they can also arise because of a combination of both of these. This is one of the more important reasons that you should always prepare a flexible budget when you are doing variance analysis. So you can, at some level, control for the volume variance that arises, given the fact that the volume might not have been exactly originally what was intended compared to the static budget. There's also a discussion in this chapter of decentralization, as compared to centralization within an organization. And decentralization is essentially the idea that individual managers at lower levels are going to be given more responsibility, more decision-making ability than they might otherwise have. So we're talking about an empowerment of employees versus dictating to employees what they should do. Certainly when managers have a sense that they have some control, some power, it makes them feel like they are more involved with the organization and more in tune to what the objectives and the goals are, and perhaps helps them achieve those goals by giving them the authority to take steps that they believe need to be accomplished in order to get that done. One of the ways you can do this, of course, is by tracking the variances, making sure that you can establish why variances arose, and hopefully making corrections when possible well in advance of them getting worse. And that's one of the main reasons that we do variance analysis, to be able to allow managers to see that a problem is existing and maybe, as I say, can be dealt with quickly rather than waiting until it gets substantially worse. Okay, that's really all I have for you this evening. I will see you next Wednesday at John Carroll. Take care.